The best real estate people are those who come from a background of, even if it's not a real estate business.
Well, Jay, thank you for coming on this show today. How's your day going so far?
It's going great. Thanks for having me, Joe. Really excited to be here.
Yeah, it's you've got an interesting career. You're an entrepreneur, real estate investor, author. Matter of fact, I found you because of the book that you wrote, which I think is what I really want to talk about today because the numbers behind every acquisition or every investment is key, right? And I think we're seeing a transition. We used to be able to buy properties and just hold on, wait for that appreciation and property values to go up, and it's not that way anymore. So today I want to talk about mastering the simple formulas behind every great real estate deal for a foolproof investing strategy. And I think you're the guy to lead us down that path. So again, thank you for coming on. Where do we start? I read your book and I'm like, I have ADD. So I'm like, man, I had to go back and read these things so often because it was such great information. Um, what do
Yeah,
you see as being the most important um, factor in for looking at a property right now?
so I think it goes back to the basics. And at the end of the day, if you're buying buy and hold real estate, what you're buying is a business.
Mm-hmm.
And it so happens that the thing that you own, your inventory, is units. It's real
Yep.
estate. It's housing. But that's no different than owning a business selling shoes, or a restaurant selling food, or a car dealership selling cars, or a furniture warehouse selling furniture. You're just a business that you have inventory, you have customers, and you're selling that, or leasing, in this case, that inventory to those customers. And so if you want to run real estate well, if you want to operate real estate well, you need to understand the basics behind running a business, any business. And I like
Mm-hmm.
to say that the best real estate people aren't necessarily the ones that come from experience swinging a hammer, or being a broker, selling real estate, or doing mortgage loans. The best real estate people are those who come from a background of running a business, any business, even if it's not a real estate business. I come from the tech world. I ran some tech businesses for some very large corporations. And when I got into real estate, I knew nothing about real estate. I bought my first house when I was 37 years old.
Right.
And I didn't know how to paint it. I didn't know how to do carpentry. I didn't know how to deal with title issues or closings or any of that stuff. But what I did know how to do was I knew how to run a business. I knew how to
Right.
manage people and hire people and manage inventories and manage cash flows, understand financial statements, all of those things. And because I could run a business, again, real estate was just another one of those for me.
Yeah, I think, when I hear somebody say passive income in real estate, I kind of I've owned a lot of different types of real estate. There's nothing passive about it, unless you're investing in a fund or something like that. But so now you were at Microsoft, right?
I
A
was.
major company. What aspects of running a large company or being part of a large company like that did you take into your daily business?
So the biggest thing is understanding that big companies and small companies should do the same thing. Big companies know how to segment tasks,
Mm-hmm.
and they segment their employees and the people that are working in the business to do specific things. So when I was at Microsoft, I started out as an engineer, and I did engineering for a long time, and then I moved into management, and then I moved into doing some product stuff, what's called product. And when I was an engineer, you wouldn't catch me doing marketing stuff. You wouldn't catch me doing sales stuff. You wouldn't catch me talking to customers. When I was doing product stuff, you wouldn't catch me fixing bugs, or going out into the field and working
Right.
with customers. I knew my role, and my role was very specific, and I was hired because I was really good at it. Too often in real estate, I find that people try to do everything themselves, or they try and hire generalists into their business that can do a whole bunch of different tasks. But at the
Mm-hmm.
end of the day, they don't do any of those tasks particularly well. So I started out flipping houses. And when I was flipping houses, I recognized that there were really four major parts of that business. There was finding the deals, there was raising the money, there was doing the renovations, and then there was selling the properties on the back end. And so I basically segmented my business into those four major components. In a rental business, in my multifamily business, it's very similar, except we add one more component, which is the leasing component. And so for us, we like to have qualified people in each of those areas of the business. So we have somebody that's really good at finding deals. We have somebody that's really good at raising money. We have a property management company that's really good at managing tenants and maintenance and all of those things. We have somebody that's really good, a broker that helps us on the back end to sell properties when we're ready to sell properties. We have a great set of contractors that can renovate the properties. And we don't mix these groups. We don't have the person finding deals, also raising money, also managing the property, because what they're good at is finding deals. And so I think the first thing anybody really needs to do if they're going to get into this business is to recognize you're not great at everything. And it's really important to have the right butts in the right seats, to have the right people filling the right tasks, not try to do everything yourself and not try to find one or two people that can cover everything. Because if you do that, you're just going to find that there are lots of gaps that are never being covered.
If you'd have tried to do everything yourself, you couldn't have scaled to the size that you scale. Because how many homes did you end up flipping?
We flipped about 450.
Yeah. If you tried to do that on your own, you would have done 20. You know,
Exactly.
you wouldn't have been able to do it. How long did it take? You started flipping homes, right? So how
Yep.
long did it take you to figure out that okay, we need some systems, some processes, and that's how you got up to 400 flips, and
Yeah.
now
So
multifamily investments?
yeah, and it hit us pretty hard after about a year when we started to do more volume and we realized that doing three times as many houses took us three times as long, or took three times as much of our time. And if you're working 8 hours a day and now you have to spend three times as much time, now you're not sleeping.
Right.
And it was really about a year after we started, we had our first baby. And we went from my wife and I doing this together to basically my wife not being able to help much anymore,
Sure.
taking care of the baby, and I had to figure out how to do it myself. And so, yeah, there were a bunch of systems and processes that we put in place. And so we can talk about the systems and processes specific to any business, but then there's some higher level concepts that we need to be thinking about when it comes to systems and processes. Number one is make sure you're writing down those systems and processes,
Yeah.
because people can spend a lot of time coming up with these systems. But if you don't write them down and a key employee leaves, or let's say you go on vacation for a month and you want somebody else in the business to take over your job, you can't do that if you haven't written down those systems. So number one is if you're going to have systems and processes, make sure you write them down. Number two is make sure you replicate as much as you can. My wife and I used to give a presentation on flipping houses where we would bring up a slide and we would show a picture of it was like 10 pictures of this one house, this one kitchen. And I asked people in the audience, so what do you think of that kitchen? Everybody was like, that's a really nice kitchen. And then I would tell them that's actually 10 different kitchens. It was 10 different houses. But we did the exact same remodel on every kitchen that we did. We used the same flooring and the same cabinets and the same countertops and the same sink and same faucet and same lighting and same everything, same hardware on the cabinets, because we knew that by replicating that, we could gain efficiency. We
Right.
knew we could go out and buy 10 sets of appliances as opposed to just one at a time. We could buy 400 linear feet of countertops as opposed to 20 feet at a time. We could buy flooring in very large batches as opposed to small batches. That would save us money. And it would also help our contractors. I remember the day we realized how valuable that was. My wife is a design person. And one of the things she loved most about flipping houses was she loved to pick out the colors. Every time we did a house, my wife would go and pick out another color scheme. It was
Yep.
great. Our houses were beautiful. But that took her a lot of time. Like she'd be going through her Sherwin-Williams book. She'd go to Sherwin-Williams. She'd look at samples. She'd put samples in the wall, blah, 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 blah.
Yep.
I remember this one house where she gave the contractors the wall color for the house. And it was a Sherwin-Williams 4-digit number, handed it to them, went off. A couple days later, I went to check on the house to see how it was looking. I walked in and the interior of the house was a light purple.
Light
Turns
purple.
light purple.
Woo.
Turns out my wife wrote down the Sherwin Williams number, but somewhere a number got transposed. And the contractors are like, yeah, it's weird, but that's the color she picked, so we're painting it. Never stopped to think, do I really want to be painting this light purple? And so that was the day we realized that we need to be painting every house exactly the same.
Yep.
So that way our contractors know
One
every
color.
house. If they for some reason find a color that's different than the last 50 houses they painted, they're doing something wrong. And so those are the types of things you need to be thinking about. Write your systems and processes down, replicate your systems and processes. Yeah.
Jay, one thing I'm hearing you say is that is also a branding thing. So if you have multiple homes in an area, and somebody walks in and goes, "Oh, I don't like this floor plan," you can say, "Hey, lucky for you, I've got the same house right down the street with a different floor plan."
I feel like you were at that presentation because we talk
Oh,
about that. We talk about that a lot. We had agents that would come and look at a house,
mm-hmm.
and then they would go look at another and another, and they'd come back to us and they'd say they all look exactly the same, which is great because I can, like you just said, I can bring a buyer to show the house. If they don't like that area or that location or that street or that floor plan, or they need a little bit more, a little bit less space, I
Right.
can basically tell them you can have the same house, pick a different location.
Yeah, that's and it's you'll become known in the community. So we when we were doing multifamily investments, we did the same thing. All of our units looked the same. If you went into any of our companies, multifamily, you were going to get the same product, and we could just buy it at we buy in bulk sales. You get the same sinks, you get the same everything,
Yep.
in every building, every apartment that we own. And people love that. There was no changes. I tell you another thing they liked was I don't know if you guys do this, but an accent wall.
Yep.
And we did an accent wall that made people. We got known for like hell for an extra $25 a month. They'll give you five choices. You can pick it, so it makes it a little bit different. But people in the community will pick up on that.
Yep, 100%. And we talk about economies of scale often, which
Mm-hmm.
means like you do things in at scale, at volume, and you save money. But we also have to think about efficiencies of scale, which means at scale, at volume, you also save time, and your
Right.
contractors save time, and your employees and your property management company, everybody saves time. And saving time is in many respects even more important than saving money.
Yeah. Yeah. And that's one thing that a lot of newer investors, they don't think like that. If you're paying somebody an hourly wage to be out there doing your turns and they have to run to Home Depot and pick up something else, buy it in bulk, have it on the property. Hopefully, you've got storage right there, save a lot of time,
Yep.
and labor. Um, let's talk about what are the metrics you look for in your investment? What do you think right now are the key metrics that every investor from beginning to more experience, what metrics should they be looking at?
Yeah.
What are
At
the
the end
most
of the
key?
day, yeah. At the end of the day, there are four ways that real estate makes money for us. Number one, it generates cash flow. And for a lot of us, not everybody, but for a lot of us, cash flow is important. We need the cash flow to pay our bills and to put food on the table and to put gas in our cars. And so cash flow is one way of measuring returns in real estate. Another is appreciation. So real estate appreciates. Now, we often think when we hear the word appreciation, we think buy something, hold it, it goes up in value. Historically, real estate's gone up in value at about the rate of inflation, about 3.1% over the last 100 and some years. Not bad, but it's really just a wealth preservation tool. If real estate's going up at the rate of inflation, basically we're not losing money by putting money into real estate. But where appreciation really helps in real estate is that forced appreciation. You buy something that's undervalued, something that's run down, something that's mismanaged, and you renovate it, or you put in better management, or you lower the operating expenses, or you raise the income. Now you've added value to that property. So appreciation is another way of measuring returns. The third way is this thing called amortization. So basically, you buy a property, you get a loan on that property, and over 5 or 10 or 30 years, your tenants are paying down that loan. They're paying the principal on that loan. And so you might get a loan for $150,000 to make up a number for 20 years. In 20 years, your tenants have paid down that loan. You've basically built up $150,000 in equity thanks to your tenants. So that's the third way. And then the fourth way is tax benefits. A lot of people who are not in real estate, and even a lot of people in real estate, don't recognize that tax benefits in real estate are some of the best tax benefits on the planet. There's a lot of incentive for real estate investors to buy real estate, and that incentive is generated through tax benefits. So when we're looking at our returns, when we're looking at what real estate is doing for us and why we should be buying a piece of real estate, those are the four things we need to look at. We need to look at cash flow, we need to look at appreciation, we need to look at loan pay down or amortization, and we need to look at tax benefits. And typically, every deal is going to offer some combination of those. And so if anybody's looking at a deal, it's important not to look at a single metric. I know a lot of people who say, yeah, if I can get a property that generates $250 a door, I want that property, or a property that generates 8% cash on cash return, or a property that generates 6% in loan pay down every year. Those are all great metrics, but you
Mm-hmm.
have to look at every deal holistically. And you have to look at all of those return metrics for every deal to see what it's really offering you. And then most importantly, you need to figure out what is important to you as an investor. Again, if you don't need cash flow, well, then tax benefits or amortization or appreciation may be a whole lot more important. And so you should be looking at those metrics first. Maybe you need the cash flow and you need nothing else. You just quit your job and you've got nothing to live off of. In that case, maybe you're willing to go with zero tax benefits and very little appreciation if you can get high cash flow. So you need to ask yourself what you're looking for, and then you need to look at the deals and analyze them in a way that you can determine how those deals are returning to you in those four forms.
Um, for a buy and hold investment, what's your favorite metric to look at when right off the cuff
Yeah,
when you're looking
it's
at it initially?
so if I'm buying it for me
Mm-hmm.
personally, I care about IRR, internal rate
Okay.
of return, and IRR is this somewhat complicated,
Yeah,
obfuscated
I was gonna say,
metric. But at the end of the day, what it is it measures compounded return. And the reason I like it isn't because the number really matters to me. If somebody told me I've got a deal that generates a 10% IRR versus a 15% IRR, that number doesn't matter to me. The value in IRR is that it allows you to compare different investments. So whether I'm looking for a 10 or 15% IRR today doesn't really matter. What matters is if I'm looking at two investments today and one of them is generating a higher compounded return, a higher IRR, it's probably, assuming the risk of the two investments is the same, it's probably a better investment for me. So it's a great way to compare investments. Because for me, it one of the nice things about IRR is it kind of blends all four of those types of returns I was talking about earlier: cash flow, appreciation,
mm-hmm.
amortization, and tax benefits. All of those kind of get factored into that one number. And so for me, I look again from a holistic standpoint. So IRR is important. That said, a lot of what we buy these days is big, large multifamily, and we have investors. And
Mm-hmm.
so the metric that's most important to me today is whatever metric is most important to my investors. And so I have investors that really want tax benefits. They don't need the cash. They don't need the cash flow. What they need is they have a high paying W-2. Their spouse is a real estate professional, so they can take advantage of those losses, and
Yep.
all they want is $1 million a year in additional tax benefits and losses that they can use to offset their W-2. If that's what my investors want, well, that's what I'm going to be looking for. I have other investors that they care about risk. They don't care
Yeah.
about a lot of cash flow. They don't care about tremendous returns, but they want low risk and they want to be able to beat treasury yields, or they want to be able to beat the stock market. They're happy with a 10 or a 12% return. And so for them, that's what I care about most. I care about risk. And so I'll find deals that are low risk, or I'll structure a fund, or I'll structure a deal that in a way that's low risk, because that's what my investors want. And so there's what I want, and there's what my investors want. When I'm raising money from other people, all I really care about is what my investors want, because that's the thing that's going to allow me to raise the most money.
What do you think? What a rent growth? What's it look for in 2024, 2025?
So I obviously don't have insight into every market, but I
Yeah.
think
And your investments, let's talk
yeah,
about it.
yeah. So nationwide, I think it's going to be muted. I think it's going to be slower than what we've
Yeah.
seen in previous years. So it should be positive. It looks like in most asset classes, most commercial asset classes, in most markets, we should see positive growth. I know Class A through the Sun Belt is seeing a ton of inventory coming online this year. So if you're in Class A in the Sun Belt or Texas, you may find that you're not seeing much rent growth just because there's so much more supply coming online. But I think multifamily in general should see 1% to 2% growth in most markets, which is a little bit less than what we've seen over the past decade. It's certainly a lot less than we've seen over the past couple of years, but just positive rent growth, I think, is important. The other thing I think that we need to keep in mind is that we can't keep underwriting to 2% or maybe even 3% expense growth. We're seeing inflation well over 3%, even by government numbers. So we need to be underwriting and using pro forma numbers for expense growth at well over 2 or 3%. For insurance and property taxes, we're using over 5% in some markets. So I think we need to be really conservative, and it's going to be a tough year or two, but I think we are slowly going to grow out of it.
The insurance is affecting you guys pretty hardcore, and especially in Florida, right?
So yeah, we don't own multifamily in Florida, but we own a
Right.
bunch of
Yeah.
multifamily in Houston, and
Yeah.
Houston is gotten pretty hit pretty hard with insurance rate
Yeah.
increases.
Yeah. Yeah. I heard. What asset class are you focusing on right
We primarily focus on large multifamily.
now?
I
Okay.
do own a lot of single family as well, but large multifamily is kind of my focus these days.
Okay. When you get a property, I think we always look at the number of the property. I don't think I hear a lot of, especially newer investors, they're not looking at the area. They're not looking at what's going on in the community. Could you kind of touch on that, please?
Yeah, that's the big mistake that I see investors
Yeah.
make. If we're flipping houses, the life cycle of a deal is weeks or months. I buy a
Hmm.
house today, and the goal is in 4 weeks or 4 months that I'm selling that property and I'm moving on. Very little happens in most markets in 4 months. So I don't really have to worry about are there going to be more buyers in this market in a few months? Are there going to be fewer buyers? But the life cycle of a multifamily property or any buy and hold property can be years, it can be decades. And so if I'm going to be holding a property for 3 years or 5 years or 10 years, it's important for me to know that I'm going to have customers in 3 or 5 or 10 years. And when I
Yeah.
talk about customers, I'm talking about two things. One, I need people who will potentially rent those units. Those are my main customers, but also I'm going to want somebody who's going to want to buy that property when I'm ready to sell in the future. And so, how do we ensure that we have more customers? Well, we look at population trends. I want to see if I'm buying in an area that we're seeing population growth in that area. I don't want to see that we're seeing 1 or 2 or 3% population decline because that means my customers, my potential customers, are leaving. I want to see more customers coming into an area because that generates more demand. More demand means higher prices. And so, number one thing we look for is population growth in any market that we're in. Number two, we look for employment growth. So, what brings people to a market? Well,
Yeah.
employment, jobs. And so we want to see that a market has incentives for businesses to come into that market. We want to see that businesses are coming into that market because that means people are going to come into that market. And then the third big thing that we look for is this thing called employment diversity. So we want to see that a market isn't dominated by any one company or any one industry because that poses risk. So think back to the 1980s and Detroit. We all know that well, we don't all know, but if you were alive during the 80s and you were paying attention, you knew that Detroit did really well.
I
It was
know.
the hub of car manufacturing in the world, and there was a lot of business. There was a lot of industry in the manufacturing world in Detroit, and a lot of people living there. But unfortunately, that was all there was in Detroit. And then through the 80s, through the 90s, as the manufacturing industry kind of declined, Detroit had some massive issues. People moved out, businesses moved out, there was a lot of poverty. And if you own property in Detroit between 1980 and today, you've probably lost a lot of money in real terms. And
Yeah.
so one of the things we look for is we want to see that employment diversity. Another example is if you look back to 2008, if you look at those markets that were mostly based on tourism. So I live not too far from Orlando, Florida, or think about Las Vegas, Nevada, or you live in LA, which was another market in 2008 that got hit pretty hard because it was a tourism based industry or a tourism based market. And in 2008, when money dried up and everybody was suffering, tourism tanked. And so nobody was going to Walt Disney World. Nobody was going to Las Vegas. And so if you own property in any market that was primarily a tourist destination in 2008, you may have lost a lot of money. And so we like to see a lot of different industries, a lot of different companies. And we want to know that if any industry or any one big company takes a hit, that it's not going to decimate an entire market.
Yeah. I talked to a guy that was buying. His focus was buying large multifamily around bases, military
Yep.
bases, and he had one military base closed,
Yep.
and that about wiped his entire portfolio out. And so it can't. I mean, it's great that it's there while it's there, but it closed within a year after he bought his major properties around there, and he just went all in this one area. And I'm like,
And we buy a lot of single family around military bases, and
Yeah.
that's one of the things that we're very careful about.
Yep.
Luckily, one of my business partners was longtime military. He knows many of the bases in the country. He knows what those bases are used for and the likelihood of those bases closing down. But there's still risks. If there were
Yeah.
a war and there was a large deployment from a particular base, again, that's our customers.
Yeah.
And so, yeah, you have to be aware of that because that is a major risk.
Well, we saw a lot of, Airbnb several or a few years ago. I had a guy on and he was buying, I think he had like 30 Airbnbs around Illinois and, up around lakes and stuff like that. And, I was asking about this, about the communities he was investing in. And I'm like, well, when this slows down, because it will, there's going to be a cycle. He's a pretty young guy, hadn't been through this. And as you can tell, I've been through a few
Yep.
gray hairs there. And I said, what's going to happen when you cycle? You get on the other side of this cycle? What's going to happen? He goes, oh, I'm going to be fine. He goes, last I heard, all the properties are gone back to the bank because he hadn't looked at the community and like it was a hot time to be doing Airbnb, but that community wasn't going to support it. Not everybody could be affording to go up to the lakes right now. And
Yeah.
so it's important to look at those communities that they're in.
Yeah, and I encourage everybody to do basically a risk analysis every time they buy a property. Ask yourself the question: what's the biggest potential risk when I buy this property? What's the thing that could go wrong that could hurt me the most? And so Airbnb, a good example there is I know a lot of people that have purchased Airbnbs in very small areas, not small
Yeah,
geographically, but they buy a lot of properties in one area,
right.
and they don't think about the fact that legislation is a huge risk.
Yeah,
To Florida. And we have a government here that doesn't really like short term rentals.
right.
And so if tomorrow they decide we're going to get rid of short term rentals in this area, I know a lot of people that are going to go out of business very quickly. So legislation is a big risk. So every time you buy a property, you need to ask yourself, what are the big risks? And if one of those risks happens to shake out, what's my mitigation plan? What am I going to do to try and overcome it?
Yeah, and that's just not Airbnb. That's every investment. You just
Yep.
hear a lot of people that, over the last several years, it was so easy to make money that we're getting back to, you've got to do your due diligence. You've got to understand what's going on in the community. So I think a lot of people forget how local real estate is. I can have a multifamily here on Wilshire Boulevard in Brentwood, and I could go down 3 blocks into Santa Monica, and it's similar building, completely different rents.
Yeah.
And it really makes a big difference.
Yeah, it's important that I don't want to say it's important, but I like to go into deals very much with a skeptical mindset.
Yep.
That there's something there that I need to be concerned about and figure out what it is. And once I've ruled out all the things to be concerned about, then I move forward. I know a lot of people that go to bed at night like just dreaming of those dollar signs, thinking about
Yeah.
that great deal. I go to bed at night thinking about that same deal, but I'm thinking about all the things that can go wrong with that
Yeah.
deal.
That's
And
exactly what I do. I think this is a terrible deal. How do I make it look better? And so then you dig into the analysis and you find like, okay, maybe I was wrong there. And then you hope that you find it. But I think it's key, your systems and your processes. They've got to become second nature to you. What's your exit strategy on those fixer uppers?
Yeah, so typically we expect to hold 3 to 5 years.
Okay.
So the life cycle for anybody out there that's thinking about apartments or investing with apartments, it's important to understand the life cycle. So
Yep.
it generally takes about 2 years to renovate an apartment complex. So average apartment complex will turn over every 2 years. A tenant will turn over about every 2 years, 50% turnover each year. So you spend 2 years renovating, you'll spend another year getting all the rent stabilized and getting the property stabilized. And then in the fourth year, that's when you start thinking about selling. You put together your pro forma and you take it to a broker. So 3 to 5 years is kind of the right timeline to get in and out of an apartment complex most efficiently.
Yeah. I completely agree. That's why this book I think is so important because I'm thinking a lot of this stuff, and I'm gonna put a link to it down below. I put it
I
on my
appreciate it.
website already. We'll talk about it, but um, if you were investing right now, what asset class and what geography, where would you be looking?
Yep. So again, I like population growth and employment growth. Where are people moving? People are moving into the Sun Belt. People are moving southeast, so North Carolina, South Carolina, Georgia, and then the South all the way across the U.S. So I like those areas. I like the Midwest. I think the Midwest is starting to see some growth again. It lost some population after COVID, but I think a lot of people are returning. I think there's a lower cost of living there than there are on the coast. So a lot of people moving into the Midwest from the coast. So I like those areas. In terms of asset classes, I'm a fan of multifamily. I got into multifamily back in 2018 because I thought we were going to see a recession in 2019, 2020.
Right.
Um, Obviously, nobody expected what actually happened. But given that I was expecting a recession, I wanted to be in multifamily. On a risk adjusted basis, multifamily has some of the best returns of any asset class in history. So I really like multifamily. I know you're in triple net. I really like triple net right now. I think retail, if you go with strong anchor retail, you should be pretty good right now. Self-storage. So I'm co-host of a podcast. One of my co-hosts on the podcast owns about $500 million in self-storage. So you'd think he'd be the biggest fan of self-storage, but he'll be the first to tell you that self-storage is struggling right now.
Yeah.
Typically, self-storage does well when there's a lot of transactions. When people are moving, buying, and selling, that's when they need storage. Very low supply right now. Not a lot of people buying or selling, so not a lot of demand for self-storage. Likewise with office, there may be some opportunity for office, but I'm not that brave, and I certainly don't have a crystal ball. So knowing where to invest in office right now or what types of properties to buy is outside of my area of expertise. But there's some good asset classes there, and then there's some that may struggle over the next couple of years.
But I think it's important to really understand, no matter what asset class, you've got to really look at the metrics and understand the metrics prior to your acquisition, because it's not the same as it was 2 years ago. You can't just buy a property and it's going to make money for you. Now you've got to get into the weeds and get out and walk the property, look at the neighborhood, understand everything going on that property, get into every unit, walk, talk to the neighbors. And so that's why I thought it was so important that what you put in the book. I just think this should be a textbook for every real estate investor right now, because there's a lot of information. A lot of it I forgot. I don't care if you've been an investor for a while. I had to go back and like, oh yeah, I need to take a look at that again. Now, are you raising a fund, Jay,
We
or
are.
you syndicate?
So we do both. We
Okay.
syndicate multifamily deals, and then we have a fund. It's called a preferred equity fund,
Mhm.
which basically means it's not quite debt. We don't lend money, but it's not also regular investment, common equity. It kind of sits in between. So we're a hybrid between debt and equity. Lender gets paid first, we get paid second. Other investors get paid third, so we're in a somewhat safer position than the other investors in the deal. And so we've been doing a lot of those types of deals in that fund for the last 2 years because our investors are looking for lower risk returns, and that's uh, given us an opportunity to provide that.
Okay. Are you doing any buying and fixing up, or are you out there just looking for good, solid returns that aren't going to go anywhere?
So for our syndications, we definitely look for value add.
Okay.
My partner Ashley Wilson and I both have a lot of experience in renovations and heavy construction, so we don't shy away from opportunity from properties that are distressed. We've done foundation issues, we've done fire properties, and we'll also just do a properties that are older and need cosmetic renovations. But for us, that's the easiest way to boost the value of a property and generate the returns we need for our investors.
So, well,
That
Jay, thank you very much for coming on today.
Absolutely, I really appreciate you having me, Joe.
I appreciate all the information. I'm going to put a link to the book down below so everybody can find it, and hopefully we'll get some great investors. And I look forward to getting you back on sometime soon.
Fantastic.
All right. Well, for those of you watching, make sure you give us a like. And if you haven't done so, make sure you subscribe.